All right, let's unpack this. Today, we're diving deep into the dynamic world of renewable energy, specifically focusing on a company many of you have probably heard buzzing about, Enphase Energy, or ENPH. For you, our curious listener, our mission is pretty straightforward. We're going to wrestle with those stacks of financial reports, analyst buzz, and news snippets, and really pull out the nuggets that genuinely matter to you. We're going to break down ENPH's current standing using a framework that's, well, surprisingly effective for simplifying complexity. The good, the bad, and the ugly. It's all about stripping away the noise so you can walk away well-informed and, genuinely confident in your understanding of this company. We've pulled from a fantastic range of sources today, everything from official company filings like their annual report, the 10K, that's the big yearly overview, and their quarterly updates, the 10Qs, alongside sharp analyst estimates from powerhouses like MarketWatch and TipRanks, and some insightful news from Investopedia and Simply Walsing.
What's truly eliminating here is precisely that approach of simplifying. In a world awash with information where every data point can feel like a deluge, sometimes distilling everything into these essential categories is often the clearest, most effective path to genuine understanding. This deep dive isn't just about listing facts, it's about cutting through the noise to clearly identify Enphase's two undeniable strengths, the pressing challenges it's currently navigating, and those critical sort of underlying risks that are very much on the horizon. We're essentially setting the stage to give you a clear picture of exactly where ENPH stands today, and crucially, what you as an informed observer should be watching out for going forward.
Absolutely. So let's kick things off with the good. Enphase's strengths and the positive signals that are, shining through. First up, their established market position and impressive technology. Enphase isn't just another player in the solar game. They are recognized as a clear leader in the microinverter space. For those maybe less familiar, those are the small devices on each solar panel that convert the DC power from the sun into the AC power your home uses. Makes systems more efficient, safer too. They're also leaders in integrated solar plus battery systems, which, let's be honest, is where the real future of home energy lies.
Oh, definitely. That integration is key.
And their business thrives on strong technological intellectual property, or IP, and they boast significant deployment scale, which is a massive advantage in this industry, as noted in their own annual reports. And get this. They've also strategically diversified their market presence globally. Yes, some regions are facing headwinds right now, we'll get into that. But that global spread itself is, well, it's a testament to their resilience and potential.
That global reach and technological leadership are powerful indicators.
Absolutely. And if we look at the overall market sentiment, it's clear some analysts are quite optimistic about Enphase's trajectory. For example, MarketBeat indicates that some analysts are projecting earnings growth of approximately 29% in the coming year, forecasting a jump from, $2.08 to $2.69 per share.
Wow, that's a pretty significant jump.
It is. That's a substantial leap in profitability, which definitely turns heads. And when we look at target prices, though, there's always a wide range among individual analysts. The average target price seems to be settling somewhere in the $38–$40 range, according to insights from both TipRanks and MarketBeat. This suggests, well, a baseline level of confidence in the company's future value, despite the current market complexities. Right. And we can't ignore their track record of past successes either. What really caught my eye in their reports was how consistently ENPH has had quarters where both revenue and earnings per share, EPS, impressively exceeded estimates. You can spot this trend in reports from TradingView and their own annual reports. This isn't just luck, it really points to proactive and, frankly, smart management. They've been actively working to mitigate the impact of rising costs, like those pesky tariffs we're hearing so much about these days.
Yeah, those are a big factor.
And they've been effectively managing their complex supply chains, which is a huge deal in today's global economy, as reported by Investopedia. So they've got a solid foundation, showing a company with real momentum.
Absolutely, and that momentum is reflected in some very optimistic analyst projections. But it's precisely this strong track record that also creates a certain kind of vulnerability, which leads us directly into what we're calling the bad.
Right.
Those current headwinds and genuine concerns that are making things, well, a bit more challenging right now.
Okay, here's where it gets really interesting and maybe a touch thorny. Tariffs on goods, especially those critical battery packs sourced from China, are directly squeezing Enphase's gross margins. Investopedia indicates that ENPH itself anticipates a sizable margin impact in upcoming quarters, specifically because of these tariffs. But how much control do they really have over mitigating that, especially with such a, globally intertwined supply chain?
That's a fantastic question, and frankly, it's a tightrope walk. While they've stated mitigation strategies are in motion, things like shifting sourcing or maybe optimizing product design, their own words, take time, tell you this isn't a quick fix. What's particularly insightful here isn't just that tariffs hurt, but how. Because Enphase relies so heavily on these highly integrated battery solutions, the tariffs on those specific components hit their gross margins, the core profitability of their actual products, far harder than they might for a company with a different supply chain or product mix. It reveals a kind of structural vulnerability that's maybe easily overlooked.
I see.
And this tariff pressure actually compounds another problem we're seeing: significant softness in demand, particularly in key regions.
So it's like a double whammy then. Tariffs squeezing the profits on one end and less demand pushing down sales on the other. Where are we seeing this demand softness most acutely?
Exactly. Simply Walson points to a noticeable weakening in Europe, showing considerable declines in demand there. And it's not just across the pond. The U.S. market is also experiencing softness. This domestic challenge is attributed to a whole mix of factors, including high interest rates, which obviously make solar installations more expensive for homeowners, a reduction in various incentives, and local subsidy cutbacks in several states. Market Watch highlights that this regulatory and incentive risk is very real, and it directly impacts consumer adoption and, by extension, Enphase's sales volumes. For example, any changes to crucial net metering rules,
Net metering, yes.
which dictate how homeowners get compensated for the excess solar power they feed back into the grid, that can significantly dampen demand.
That's a tough environment to navigate for sure. And let's not forget the market's high expectations. What really caught my eye in the reports was this notion of the punishment for missing expectations. It's almost as if Enphase's very success has created its own challenge, like a trap of incredibly high market expectations. Because ENPH has delivered such strong growth in previous years, the market now expects, like, near perfection. Is that a fair way to see it?
Absolutely. It's a classic double-edged sword. Investors have just grown accustomed to their strong performance. So any deviation, even a slight miss on revenue or gross margin, tends to be punished sharply by the market. It happens fast. And adding to that valuation concern is the widespread in analyst ratings, which really tells you there's no clear consensus out there. While some analysts are very bullish with high targets, others are much more pessimistic. The average target price of around $39, $40 from sources like TipRanks implies, well, somewhat limited upside from certain stock price levels.
But I wonder, though, isn't that just the price of admission for being a market leader? The premium you pay? Or are analysts maybe being overly cautious here, perhaps missing the long-term forest for the short-term trees?
That's a fair challenge. Some would argue it's a premium worth paying for a company with such strong IP and a leading position in a definitely growing sector. However, the flip side, and this is where it gets into the ugly territory, is that this premium valuation makes them incredibly vulnerable to wider industry risks, like, say, changes in government support. This means the stakes are incredibly high, and any significant shifts can have a really amplified impact.
That makes perfect sense. So let's talk about those significant risks, the ugly stuff you absolutely need to watch closely.
Okay, yeah. Zooming out a bit, it's pretty much impossible to talk about the renewable energy sector without acknowledging that government support is, well, undeniably crucial. Solar incentives, subsidy programs, tax credits, they form a really substantial part of ENPH's demand model. This isn't some hidden risk. It's highlighted directly in the company's own SEC 10K filing, which explicitly lists risk factors about government subsidies expiration. Any changes in policy, whether that's cuts in incentives, alterations to those net metering rules we just discussed, or new tariff regimes could significantly hurt sales. It's a foundational risk in the entire industry that Enphase is just inherently exposed to.
Right. Then there's the supply chain and cost inflation, which we touched on earlier but maybe need to underscore. ENPH relies heavily on global sourcing for many of its critical components. This global exposure, while offering benefits, also exposes them to considerable risks, like new tariffs, material price inflation, disruptions in shipping and logistics, all that stuff we hear about. Investopedia notes that Enphase has already warned about margin compression stemming directly from these kinds of tariffs. It's a constant battle to manage these moving parts, and in a climate of high inflation and geopolitical uncertainty, that battle only gets tougher. It's almost like trying to plan a massive construction project when the price of every single screw and beam is changing by the week, isn't it?
Exactly, and that uncertainty is a major headwind. It makes planning very difficult. Another dimension to consider is just how quickly this market is evolving. I mean, it's fast. The market for integrated solar, battery, and inverter solutions is becoming increasingly crowded. This competitive pressure means that new players or existing competitors might try to undercut prices or bundle their services differently, potentially reducing ENPH's market share. Moreover, downstream players, like the installers and energy service companies, they're constantly evaluating their options. They might shift their preferences based on cost effectiveness and new offerings, which could further impact Enphase's distribution channels.
It's almost like a gold rush, isn't it? Everyone sees the potential, and suddenly your unique selling proposition isn't quite as unique as it maybe used to be. I remember seeing a similar competitive squeeze in the early days of cloud computing.
Precisely. A very good analogy. And for Enphase, that means they can't just rely on their tech leadership. They have to actively defend their turf. And finally, we get to liquidity and earnings consistency. Given those consistently high valuation expectations we talked about earlier, if demand falters, whether regionally or globally, ENPH simply has less margin of error.
So it's a tighter rope walk for them than for companies with maybe lower market expectations. This means that negative surprises in their earnings reports can significantly amplify any downside in the stock's performance. A small miss can become a big deal.
Exactly right. Okay, shifting now to the forward outlook and what analysts are generally saying. The overall consensus among analysts for Enphase is currently a hold rating, according to both MarketWatch and TipRanks. This hold reflects that mixed set of expectations we've been discussing. While some analysts believe ENPH's stock might offer modest upside from current levels, others are considerably more cautious, acknowledging the various headwinds. It's essentially a kind of wait-and-see approach for many right now.
Okay. And looking at specific projections, what are the numbers suggesting?
Well, TipRanks estimates future EPS for the next quarter to be around 63 cents. Now, this is a slight decline from a past figure of 69 cents, suggesting some expected decline or perhaps ongoing margin drag, which ties right back to those tariff and demand pressures we've been talking about.
Makes sense. And revenue.
As for revenue, estimates for the next quarter hover around $359 million as a midpoint. But the actual figure, of course, is going to depend heavily on demand trends, especially in Europe, and the evolving impact of those tariffs we've been tracking. Lots of variables.
Okay. So what does this all mean for you, our listener? Let's try to synthesize this. Based on everything we've unpacked today, Enphase looks like a company with genuinely solid technology, a strong brand presence, and excellent exposure to a sector, solar and battery, that is highly likely to experience significant growth in the long term. That part seems clear.
It does. The long-term story is compelling. However, short-term, the risks are significant. Tariffs, margin pressure, those regional demand swings, and those ever-present high expectations. They create a really challenging environment right now.
So for someone considering this company, it's not just, is it good or bad, but maybe more like, what specific data points are you tracking to confirm their trajectory?
That's the key. If you were considering this company, you'd likely want to see maybe a couple of quarters of stable margin improvements and clear guidance indicating that tariff impacts are being effectively managed. And, critically, that demand, especially in Europe, is showing real signs of returning. You'd want to see proof points.
Okay, let's unpack this one last time then. We've taken a deep dive into Enphase Energy, breaking it down using that simple framework, the good, the bad, and the ugly. It's a powerful reminder, I think, that even the most complex financial landscapes can indeed be understood through a simpler lens sometimes.
It can. But this also raises an important question for you, the listener, to ponder. In a market as complex and dynamic as renewable energy, when does keeping things simple truly illuminate the path forward, allowing for clarity in your understanding? And when might that pursuit of simplicity inadvertently cause us to overlook critical, nuanced details, like maybe the subtle shifts in installer preferences we mentioned, or the precise mechanics of how a tariff impacts gross versus operating margins? Details that could be vital to truly understanding a company like Enphase. We encourage you to keep exploring that balance in your own journey to understanding.